First quarter of the year has been a pretty volatile one for Kenyan equities. The NSE 20, for example, hit new record lows in trading sessions in the middle of March, and a late rally has left the bourse as a worst performer among the ones that we track on the program. In the year to the 30th of March, the JSE Top 40 has gone up by 4%, with a late March rally spurring the index higher. The EGX 30 up north in Egypt and the all-share in Nigeria over in the west were up by 9.7% and 5.5% respectively. Compare that to the 3.8% fall in the Kenyan index. Now, the decline of the NSE 20 can be partly but not wholly explained by the fall in the biggest listed firm at that bourse, Safaricom. It had 2.8 million clients in Ethiopia as of this month. It's growing at a fairly rapid pace, and it also reported a marginal drop of around 1.7% in net earnings. But those net earnings were still fairly big, $509 million US. Equity and KCB reported double-digit increases in net earnings for 2022 as well. But the market response was tepid at best, despite at least $1.2 billion in net earnings between these three firms and a record dividend in Equity Bank's case. So what combination of external and internal headwinds is the Kenyan bourse running into, which partly explains this downturn? I explored that some hours ago with Musau from Standard Investment Bank.
We had quite a bit of volatility. Your KCB, your Safaricom touched 6-year lows during the quarter, but bounced back. Equity Bank touched 2-year low and bounced back as the numbers came out. So certainly a very interesting period for the market.
A big chunk of trading at the Nairobi Securities Exchange is driven by a lot of foreign investors, a lot of foreign funds coming in and trying to essentially get a bit of yield in our market. But given all the dollar access problems that we've seen taking place in this market, last year, I believe around this time, Q1, JP Morgan was telling traders, look, we're having a bit of a problem finding the dollars to settle the trades that you guys have at the moment. To what extent has that contributed to the decline that we've seen in the NSE 20?
Well, I think that has been a concern, but investors actually started selling out of our markets maybe even 2 years ago. And it's been a continuous trend the last almost every quarter for the last 2 years. And that's been mainly because of higher interest rates in the developed countries, because that's not reflected in the domestic market where inflation has remained mostly under control. This week, the Monetary Policy Committee raised the central bank rate by 75 basis points to 9.4%. And we're waiting to see if that's going to be significant enough to make a difference in terms of the market.
In real terms, though, does it really make a material difference? And I'm looking at it in terms of, trying to figure out where individuals will decide to place their cash. Given, for example, if you look at what's happening with T-bill rates, the 91-day one is just shy of 10%. The 364-day note is close to around 10-point-something% as well. So in real terms, though, the yield there is around 2%, 1%, give or take. Don't those rates need to move a little higher to entice more capital to come in?
Yeah, I think Kenya has been slightly lucky because we have a very well-developed domestic capital markets and asset management sector. And you can say to some extent that that's really been what has made the government still be able to maintain rates at these levels. So your pension sector, your commercial banks have all been piling their cash into debt instruments. And essentially under-allocating away from equities. That's really been the key support for the market, but otherwise interest rates would have been a lot higher if we were relying completely on foreign investors.
Do you expect them to go any higher? Because, when listening to the MPC, listening to the governor yesterday and then reading the MPC statement as well, some of the things that they were talking about with respect to inflation risk was they expect it to be pushed a little higher based on one hand, you've got a slightly weaker shilling, so that the pass-through effects of that into the economy with the huge amount of things that we import, fuel, food, and so on and so forth. We have new power prices coming in from the 1st of April as well. On balance, the factors seem to be in favor of inflation going up in future.
We take a different view. We think inflation, even if it's going to go a little bit higher, I think we've almost peaked. And in fact, the last couple of months, we've not gone beyond 10%. And I suspect in the coming months, we are unlikely to go beyond that level, and we're going to start seeing a retraction. We think the reason central bank raised the MPC rate could have also been driven by the exchange rate situation. We saw most of the developed countries raising their benchmark rates. And so, and the exchange rate has been a major concern. And we think really that increase was less driven by inflation concerns, but rather driven by exchange rates.
If I understand your prognosis correctly, that also presupposes that the shilling doesn't have much more to slide. Am I getting that right?
Well, yes, we've already moved to around 130. We may still have some weakness. We're seeing a lot of the commercial banks paying dividends. Safaricom is actually paying its dividend around this time. And so we might still see some weakness. But there are also other initiatives to provide some stability. So we think within the 130 to 140 level is a significant enough adjustment for at least the first 6 months, maybe even 8 months of the year.